This lecture is over mergers and acquisitions. I'm your professor, Dr. Stephen Haggard. So when we talk about mergers, what are we talking about? The basic concept is that we start with two or more companies and end up with one. Now I'm going to use some vocabulary throughout this lecture, so we should probably teach you some new terms. First, there's bidder. This is the acquiring firm. This is the firm that's going to buy the target. The target is the firm that is sought, or the firm that will be bought. And then there's consideration. That's the cash or securities offered for the target firm. We're going to see that most mergers are usually done with cash or with the bidder's stock. Everything we talk about in this lecture can fall under the general heading of takeovers. What is a takeover? It's really a general and imprecise term referring to the transfer of control from one group of shareholders to another. Take a look at the diagram down at the bottom. We can talk about takeovers as being one of three things: either acquisitions, proxy contests, or what are known as going private transactions. And inside of acquisitions we have three subgroups: merger consolidation, acquisition of stock, and acquisition of assets. We'll start by talking about acquisitions. The first type of acquisition we'll talk about is the merger consolidation. And merger consolidations really fall under two categories. The first is the true merger. That's the complete absorption of one company by another. One firm survives. I'll give you an example here from my own career experience. When I worked for Halliburton, we acquired a company called Dresser. And afterward, there was one corporate headquarters, and the name on the building was Halliburton. And so Dresser had been completely absorbed by Halliburton, and only Halliburton survived in the end. Now that is contrasted to the consolidation, which is where two firms go together to form an entirely new firm. An example here might be Daimler Chrysler. In truth, this is hardly ever the case that it's truly two firms going together to form an entirely new firm. And many times these things are touted as a merger of equals, but in fact they are not. How do we know that Daimler Chrysler wasn't a merger of equals? Everyone in the power structure after the consolidation was a German. In other words, they were from Daimler, not from Chrysler. Now you may have noticed that during my discussion of consolidation I used the term merger, as in merger of equals. In practice we generically refer to both of these things, mergers and consolidations, as mergers. And in truth that reflects the reality in most cases, as it did with Daimler Chrysler. Mergers have their advantages and disadvantages. The advantage to a merger is that it's legally simple. It does not require the transfer of title for individual assets. Therefore, mergers can be accomplished at a lower cost. Lower cost than what? Well, we'll talk about something called acquisition of assets later in the lecture. And in an acquisition of assets, you have to retitle every single asset that is purchased. What are the disadvantages of mergers? Well, they must be approved by a vote of the shareholders of each firm, and typically it needs to be greater than or equal to 2/3 of the shareholders. Why greater than or equal to 2/3? Most firms have what's called a supermajority provision for voting to accept or reject an offer. And obtaining the votes might not be easy because target managers are likely to resist. And if the managers represent a large block of stockholders, say a quarter to a third, it might make it difficult for you to get 2/3 of the shareholders to approve of this transaction. Now, why would target managers probably resist a takeover? Well, typically target managers don't have a job after the takeover. After all, a company only needs one CEO, one CFO, and so on. And so the target managers usually lose their jobs. Not a good outcome for the target manager. Next, we'll talk about something called an acquisition of stock. In an acquisition of stock, what the bidder does is to purchase the target's voting stock with cash, shares, or other securities. If you can't get the firm's current shareholders to vote for a merger, you just buy their stock and with it buy their votes. How does the bidder buy the stock? Well, they make a tender offer, which is frequently contingent upon the bidders obtaining a minimum percentage of the voting shares. Why a minimum percentage? Well, they need enough to make sure that the acquisition will be approved. Plus, if the firm buys less than 80% of the outstanding stock of the target, then any dividends received from the target will be taxable. Tender offers are generally made through public announcements, not direct mailings. Why do you think such solicitations would not be made directly to the target shareholders via mail? Well, who has the list of the target shareholders? The target firm itself. Are they going to be in a big hurry to make that available to a bidder? Absolutely not. As we discussed in the last slide, target managers are not going to be in favor of being taken over. Now let's talk about the advantages and disadvantages of acquisition of stock as a means of takeover. Under advantages, we have that no shareholder meeting needs to be held. Why? If you own 3/4 of the stock or 80% of the stock, there's really no need to hold a shareholder meeting because anything you decide is going to go. In other words, you could hold a shareholder meeting by yourself in the bathroom at the airport. You could hold your vote there because after all, you have enough votes to do whatever you want. Secondly, it bypasses target management and their board to appeal directly to the target shareholders. We've already discussed that target management is likely to resist, but why would the board resist? Well, for similar reasons. The new corporation will not need 2 boards of directors, and we probably don't need dozens of people on our board. For instance, what if the bidder has 12 people on their board and the target has 12 people on their board? If you merged both boards together, you'd have 24 people. That's too large of a group to be really effective. So we're going to end up having to get rid of some board members. Probably 1 or 2 from the target will be placed on the new corporation's board, but the great majority will just be released. Is that a good thing for board members? Absolutely not. Being a board member pays fairly well. Plus, you get the esteem of being on a board of directors for a firm. Plus, board meetings can be held in nice locations. For instance, the Outer Banks, to go play golf when you are not meeting with the other board members. And so being a member of a board of directors for a large corporation is a sweet deal, and not one that many directors are eager to give up. So what are the disadvantages? Well, your book says it can be unfriendly, which I think is really funny. It's kind of an understatement. In fact, we call an acquisition of stock a hostile takeover. Target management can resist, and that can take the cost higher than for a merger. If you can get target management to agree to not resist, and this whole thing gets happened via a friendly vote of the shareholders, then the cost can be fairly reasonable. However, when target management starts to resist, how do you overcome that? Well, you have to raise the amount that you're offering for the target firm's stock. And a significant minority of target shareholders might hold out. If the bidder gets less than 80%, then the bidder must pay taxes on any dividends received from the target. That's U.S. tax law. And finally, complete absorption requires a merger, so you're going to have to go through a merger anyway. Most acquisitions of stock are followed up by a formal merger. Of course, the approval of the merger is quite simple. As we discussed, it could happen by yourself in the bathroom at the airport. The third type of acquisition we'll talk about is an acquisition of assets. A firm can effectively acquire another firm by purchasing all or most of its assets. These kinds of sales require a formal vote of the target shareholders, but typically only require a simple majority. Now, what can you think of as acquisition of assets? Well, how about a rental car company? Instead of buying the company itself, what if we just bought all the cars and perhaps the counters that the firm owns at the airports? Therefore, we could get our hands on the assets, but we wouldn't buy the company itself. What are the advantages and disadvantages of acquiring the assets? Well, the advantage is we don't have to worry about minority shareholders holding out. Why? Because asset sales can be approved by a simple majority of the shareholders. What does a simple majority mean? 50% plus one share. That's as opposed to the supermajority requirements of 2/3 or 3/4 that may be required to do a merger. What's the disadvantage? Well, it requires a costly legal process to retitle all purchased assets. Remember our rental car company? Think about the time that you've spent down at the Department of Motor Vehicles trying to get your vehicle retitled, if you've ever done so. Now multiply that by the thousands of cars at the rental car company. Imagine how painful and excruciating that would be. Now imagine paying lawyers to do that work. It would be very expensive and time-consuming. Now let's talk about a different way to classify acquisitions. First of all, we might have a horizontal acquisition, which is where the target and the bidder are in the same line of business. An example from recent history, AT&T's attempted merger with T-Mobile. They are both in the same line of business, mobile phones. And then we might have a vertical acquisition. This is where the target and bidder are at different steps of the production process, the same production process. For instance, a refiner, an oil refiner that purchases gas stations, or an owner of oil wells that buys a refinery. You might also have a paper mill that would buy a forest. Why would that be in the same production process? Because wood is the raw material for the manufacture of paper, and wood comes from forests. And then finally, conglomerate acquisition. This is where the bidder and target are in different lines of business. One of my favorite examples, Sara Lee, a food company, purchased Hanes, an underwear company. Now what do food and underwear have in common? Not much. What would the CEO of Sara Lee know about the manufacture and sale of underwear? Probably not much. In finance, we say that conglomerate acquisitions are usually a bad idea and they destroy value. Remember, the goal of financial management is to increase the wealth of your shareholders. If you're going out and buying target firms that are in different lines of business that you know nothing about, most likely you are not acting in the interest of your shareholders. Now we're going to talk about proxy contests. If you recall from earlier, proxy contests are a type of takeover that is not an acquisition. So what is a proxy contest? This is when a group of shareholders attempts to gain control of the board of directors by voting in new directors. Now, do these people have enough to do this on their own? No. So what do? Well, they go out and solicit proxies from the rest of the shareholders. What's a proxy? It's the right to vote someone else's shares. So if you are a shareholder in the firm and you are unhappy with the way things are going, and a group seeks your proxy to try to get rid of the current bunch of bums that are ruining the company, you might be pleased to do that. Now, what's the advantage here? Well, it's cheaper than buying the shares. In an acquisition of stock, we had to buy the shares to get the votes. Here, people are willingly giving us their votes. We don't have to pay for the shares. What's the disadvantage? Well, it can be difficult to succeed. In fact, most proxy contests fail. But occasionally, a proxy contest can lead the current management of the firm to make changes in how they manage the firm that meet with the approval of the unhappy group of shareholders. Now for the final type of takeover from our earlier diagram. It's called going private. This is when a small group of investors, that usually includes the firm's current management, purchase the shares of the firm with debt that uses the firm's assets as collateral. Now, students often get confused here and they say, how in the world can you use something as collateral that you don't currently own? Well, if you've ever bought a car on credit, then you've done exactly the same thing. And if you've ever bought a house with a mortgage, you've done precisely the same thing. You borrow money against the assets you're going to buy. Now, the shares are no longer traded after a going private transaction, which can also be called a buyout. That means that no one out there can go out and buy these shares. They are privately held. It's usually called a leveraged buyout, or LBO, because of the use of debt, or a management buyout, or MBO, because of the involvement of management. Now, if you want to see an interesting movie on going private transactions, there's one called Barbarians at the Gate. And I used to show it in my classes at other universities, but here, if you want to see it, you should probably just rent the movie and watch it for yourself. But it's an excellent primer on going private transactions. Now let's talk about what gets accomplished here. Does the management get changed out? No, it's the same group of managers as before. So how does value get created? Well, it's called the disciplining effect of debt. Typically, the kind of company that benefits from going private is one where managers are wasting the firm's extra cash on worthless things. The firm is probably a cash cow, meaning that it creates lots of cash flows but doesn't have growth opportunities, and so they end up making value-destroying investments. How are they going to buy the firm? They have to take on a lot of debt. And what does the debt do? Well, they have to make coupon payments every 6 months on that debt. And in order to do that, it means they have to tighten up their practices and stop wasting money so they can make the debt payments. And this is called the disciplining effect of debt. In other words, the debt forces them to behave well. Think about your own life. Actually, think about my life. I get up every morning of the world and think, I don't want to go to work today. And then my wife reminds me that we have a mortgage, and that in order to get a paycheck, I have to show up at work. In order to keep the house, I have to get a paycheck. Therefore, the mortgage disciplines me every morning into getting up and coming into school to teach my classes. We see the same thing with managers. If they want to keep their place at the top of the corporation and now as owners of the corporation, they have to make those debt payments. And if they don't stop wasting the firm's money, they won't be able to do it. Now we're going to talk about some alternatives to mergers. Mergers aren't always the answer to being able to work together with another company. And so we end up with a couple of other solutions. The first is a strategic alliance. And this is just a formal agreement to cooperate in pursuit of a common goal. Where do we see strategic alliances most often? In the airline industry. Some examples would be the One World Alliance or the Star Alliance. Basically, these are agreements between these airlines to share frequent flyer miles and so on, to work together to bring more business to the fellow companies of their alliance, and it helps each other out. Another example would be code share agreements between airlines. For instance, one day, it was a Friday afternoon in Dallas, Texas, I got the call that our plant in Arborough, Scotland was in trouble. And the travel people immediately brought me a ticket down and told me to go home, pack my gear, and head to the airport. I looked at the tickets and they said American Airlines all the way through to Aberdeen, Scotland, where I'd rent a car and drive to Arbroath. Now, I got on the American Airlines plane and I flew to Gatwick Airport in London. And then I started looking for the gate for my American Airlines flight. But I couldn't find it. And so I stopped an American Airlines person and they said, "Oh, that's a code share flight with British Airways. So you need to go to a certain gate at a certain terminal, and that's where my flight would leave from. And so these code share agreements, why are they good for both companies? Well, American Airlines does not have a lot of in-country flights within the United Kingdom. And British Airways certainly doesn't have a lot of in-country flights within the United States. And so by banding together, they can hand off customers one to another. In other words, they can keep their customers from falling into the hands of competitors. And so these code share agreements are for the benefit of all the airlines involved. Now the second example we typically talk about are joint ventures. This is where two firms put up money and or other assets to establish a new firm. Examples? Back in the early 1980s, GM and Toyota went together for something called the New United Motor Manufacturing Incorporated Company, or NUMMI. This is in Fremont, California. It was an old GM plant that had horrible quality issues, horrible human relation issues, horrible union issues, all sorts of problems. And so GM offered up that plant as their contribution to the joint venture. Toyota, on the other hand, offered up manufacturing technology and the Toyota manufacturing system, which was far superior to GM's. And they started building cars together. If you drive a Toyota Corolla that was built before 2008 but after, say, 1982, it probably came from this plant in Fremont, California, from this joint venture. We could also discuss Verizon Communications and Vodafone going together to form Verizon Wireless, although I heard recently that Verizon was trying to buy the rest of Vodafone's stake in that joint venture. And then there was a joint venture that I was familiar with Halliburton in Russia. After the end of the Cold War, the Russian army withdrew back to Russia, and they had lots of extra trucks left over. And an enterprising Russian bought those trucks. At the same time, the oil fields in Russia were trying to overcome decades of neglect, and Halliburton, being an oil field services company, was interested in that business. And so we went into a joint venture with this gentleman who supplied trucks, and we provided used pumps from our facility in Duncan, Oklahoma, to mount on these trucks. And so we were basically building oil field service trucks, which we then sold to small oil field service operators in Russia. And once all the trucks were gone and all the used pumps were gone, we dissolved the joint venture, split up the profits, and went our separate ways. Let's talk about what makes acquisitions taxable. When we talk about an acquisition being taxable, we're talking about taxable to the target shareholder. In a taxable acquisition, shareholders of the target firm are considered to have sold their shares and might have to pay a capital gains tax. Why would they have to pay a capital gains tax? If they sell their shares for more than they paid for them, then they have a capital gain, and as such they incur a capital gains tax. What does this mean? It means generally that cash acquisitions are taxable, unless the target shareholder bought their shares long ago at a much higher price. Recall that acquisitions happen at a premium to the current market price. And so if a shareholder paid something around the current market price, then we know they're going to be getting a higher price for their shares than what they paid for it, and will have incurred a capital gain and therefore a capital gains tax. How can you do a tax-free acquisition? Well, give the target shareholder shares in the new firm instead of giving them cash. It's just considered an exchange at that point, and therefore there aren't any taxes. Now, what are the requirements for a tax-free acquisition? Well, it must be for business purposes, not just to evade paying taxes. I'm going to tell you in a minute how you can use a merger to avoid paying taxes. So every time you hear an announcement of a stock deal, you will also hear that they say this is to improve synergies, this, that, and the other. They won't ever say, we did this to lower our taxes. And secondly, There has to be a continuity of equity interest. In other words, after the deal, target shareholders must have equity interest in the resulting firm. So you've got shares in the new firm. Now, as a target shareholder, you can take a tax-free acquisition and turn it into a taxable acquisition. How? Immediately sell your shares in the new firm, because any amount over and above what you paid for your shares in the target that you receive from that sale will then be a capital gain and will be taxable at the capital gains rate. Now we're going to talk about how you account for acquisition. The purchase accounting method says that the assets of the target are to be reported at their fair market value on the bidder's books. What does fair market value mean? For instance, if the company had 3 factories, I would find out how much each of those factories would sell for in the open market. That would be their fair market value. Any amount that we pay in excess of the fair market value is recorded as goodwill. Goodwill is tested annually for impairment, and a charge is taken if it's found to be impaired. Now, it used to be different, but that's how goodwill works now. It used to be goodwill had to be amortized over a set period. Now, the question is, why would a bidder be willing to pay more than the sum of the fair market values of the target firm's assets? Well, think about Apple. Apple really doesn't have all that much in the way of assets. They have a headquarters in Cupertino, California, and they've got some patents and whatnot. Do they own their own factories? No, they don't. So why would you be willing to pay more than the sum of the fair market value of Apple's assets? They have a tremendously powerful brand, and they have a devoted customer following. And so that's why we would be willing to pay more than the sum of the fair market values of Apple's assets. How does goodwill become impaired? Well, something happens that diminishes the good feelings or brand power of the target firm. Assume you merged with a firm, and shortly thereafter they did something horrible, like pollute the Gulf of Mexico. The goodwill you recorded on your books might not be worth as much now. So annually you have to look at that and decide whether or not the goodwill has been impaired. And if it has been impaired, you must take a charge and reduce the amount of goodwill on your books. Your book also talks about something called pooling of interests. But pooling of interests is no longer allowed in the U.S., so we won't be covering that and you won't be responsible for it. The goal of financial management is to maximize shareholder wealth, and we should apply that rule also to deciding to do an acquisition. Unless there is a gain to the acquisition, we shouldn't do it. So just like choosing investment projects, only positive NPV acquisitions should be undertaken. The question becomes, where do these gains from acquisitions come from? There are 4 possible areas that might bring benefit to us from acquisition. The first is called revenue enhancement, the second cost reductions, the third lower taxes, and the fourth reduction in capital needs. I'm going to discuss each of these in the following slides. First, let's talk about revenue enhancement. Marketing gains would be one source of revenue enhancement. What do we mean by marketing gains? Well, perhaps improved ads. What if you were a company that had great ads and you were going to take over a competitor who had been squandering their money on very bad ads? Well, you could award that work to your advertising agency and have better ads, and you might not have to have as many ads. In fact, mergers between mobile phone companies often cite the reduction in marketing costs as a motive for merger. Secondly, you might have distribution benefits. Think about a goat farmer in Springfield, Missouri. A goat farmer that makes cheese from his goat's milk. Now there is a small market for goat cheese in Springfield, but there's a much larger market beyond. What if someone like Kraft with a global distribution network were to purchase the local goat farmer's cheese operations?
They could use their large distribution network to sell his cheese far and wide, which would improve the revenue from that operation. Next, we talk about strategic benefits. And the idea here is that the acquisition provides an option for expansion. For example, Procter & Gamble bought Charmin. Charmin's a toilet tissue company. Do you think Procter & Gamble was only interested in making toilet tissue? It turns out that the same technology to make toilet tissue can be used in lots of other areas, for instance, paper towels and facial tissues. And so by buying Charmin, Procter & Gamble purchased an option for expansion into these other areas. And finally, market power. You can buy a competitor, and that might allow you to raise your prices, but be careful. If you do this across state lines, the Federal Trade Commission will become interested and investigate your firm. Next, we'll talk about cost reduction. How do we achieve cost reduction? Well, one way would be through economies of scale. That's where we spread our overhead over more units of production. Think about this. Firms only need one CEO, one CFO, one treasurer, and so on. The firm only needs one computer system and one headquarters building. And so we can sell off those pieces of the target, and now we're going to spread the cost of our own CEO, headquarters, and CFO over more units of production, including the production of the target. That allows us to reduce costs. We could also have economies of vertical integration. This makes it easier to coordinate closely related operating activities. For example, in my days with Halliburton, I used to be dependent on someone to drill a hole through the material that I had ordered to make my valves. Because I was now at the mercy of this individual, I could not make good promises to my customers about delivery dates. And because oil rig time cost $250,000 per day, not being able to make a delivery date could be very expensive to us and our customer. And so I was able to purchase a machine for my own operation that did the drilling for me, so I was no longer at the mercy of a supplier. And then we have complementary resources. This is where you make better use of existing resources. Think of two stores right across Glenstone from each other. One is a patio store and the other is a fireplace store. During the summertime, the patio store is busy, and the owner of the fireplace store stares longingly across Glenstone at the customers. But during the winter, the situation is reversed. The patio store is abandoned, and the fireplace store is hopping. So what could these two businesses do? Well, perhaps they could merge, move into one building, and sell the other building. That would be a case of complementary resources. You can also benefit from lower taxes following a merger. For one thing, you could use tax losses from the target. You could use that to offset your own profits with previous target losses, because the target might have something called tax loss carry-forwards. You could also use their unused debt capacity. Imagine a target that was running with all equity in an industry that's typically run with 50% debt. What could you do? Well, you could borrow money to buy back some of that equity and enjoy the tax shield of debt. In other words, the deductibility of interest. Then we have the use of surplus funds. Acquisitions provide a use for surplus cash that has no tax consequence for the bidder's shareholders, as opposed to dividends or share repurchases. Dividends would be susceptible to a dividend tax, and repurchases might incur a capital gains tax on the part of the shareholder. And finally, we have the ability to write up the value of depreciable assets. I could depreciate all my assets down to 0 as a target and lose the tax benefit of that. But when the bidder buys my assets, they now put them on their books at fair market value and can start to depreciate them all over again. Just because an asset has a zero book value doesn't mean it has a zero economic value. When I took over my operation at Halliburton, all the machines were almost as old as I was, and therefore had all been depreciated to zero. Yet I used them to produce $12 million a year worth of valves. Therefore, those machines must have had some sort of economic value. And if we had been taken over by someone, they could have put those machines on their books as something greater than zero. You might also experience a reduction in capital needs as a result of a merger. If the target has underutilized assets and the bidder needs more capacity, the companies together require less capital, or investment, than the sum of the two firms as separate entities. For example, right now, Hyundai's plants are operating at nearly 100% capacity. They can't produce any additional vehicles without building new factories. On the other hand, Chrysler's factories are running at around 60% capacity. If Hyundai were to buy Chrysler, they could instantly pick up manufacturing capacity without having to build any new factories. Now, this example obviously disregards the difference in quality between these two brands. In fact, if Hyundai did build cars in Chrysler plants, people would be suspicious of their quality. Here are a few tips for avoiding mistakes when you do acquisitions. First of all, do not ignore market values. If the target firm is currently trading at $20 per share, that should be your best estimate of its standalone value, $20 per share. Don't think that you know more what the company is worth than the market does. Secondly, estimate only incremental cash flows. Just like with net present value projects, we only want to use cash flows in our merger decision making that are incremental. Just buying additional earnings by buying another company is not good. Also, you want to use the correct discount rate. For example, if you are a large conglomerate, you might have a low discount rate, and you are going to buy a very risky firm. The correct discount rate to use for that NPV analysis is not the discount rate for the conglomerate. It's the discount rate for the firm being bought. After all, those are the assets that you are purchasing, and their risk is correlated to that discount rate. Finally, you want to be aware of transactions costs. Anytime you do a deal, you're going to have to retain investment bankers, lawyers, and accountants. And none of those people work for cheap. Just a side note here, replacing inefficient managers is a good rationale for an acquisition, but bitter managers often overestimate their own abilities. This is what Roll is talking about in his hubris hypothesis paper. That's a paper that you were supposed to read. I've told you you only accept positive NPV acquisitions, but I haven't showed you yet how to calculate that. So here we go. The first thing we need to do is figure out the incremental gain from the acquisition. We can put that into an equation and call it delta V. What's it equal to? Well, it's equal to V sub AB, which is the combination of the two firms, the target and the bidder, minus the sum of their standalone values. And if delta V is greater than 0, then we have what is called synergy. What is B worth to firm A? By the way, B is the target. We call that VB star. And that's equal to the standalone value of B plus the incremental gain from the acquisition. Therefore, the net present value of any acquisition is equal to VB star minus the cost to firm A to acquire firm B. Once again, we should only accept positive NPV acquisitions. Now, if the acquisition is going to have a positive net present value, what should happen to the price of the bidder stock upon announcement of the acquisition if the acquisition has a positive NPV? Well, the stock price should go up. What usually happens when bidders announce their intent to acquire a target? usually their stock price goes down. We're going to work a couple of examples using acquisition costs. I present some basic information about the acquisition here. Once again, firm A is the bidder and firm B is the target. Firm A has a price per share of 20 and a number of shares of 25. Therefore, it has a total market value of 500. That's just 20 times 25. Firm B has a price per share of 10 and 10 shares outstanding, and so it has a total market value of 100. We assume both firms are 100% equity. We estimate delta V, or the incremental value of the merger, to be 100. Firm B's board has agreed to sell for 150. This can be broken down into the firm's 100 standalone value plus a merger premium of 50. So what is VB star? Well, it's just VB, the standalone value, plus delta V. That's 100 plus 100, or 200. Now we'll use all that information to examine a cash acquisition. In this one, firm A pays 150 in cash for firm B. So what's the NPV? Well, it's VB star minus the cost to firm A to acquire firm B. In this situation, that's 150, the cash that they will pay for the firm. So the net present value is 200 minus 150. That's equal to 50. That's positive, so we're going to accept the project. Now what's the value of the new firm that's formed as a result? Well, that's just going to be the value of A as a standalone firm plus the net present value to firm A. That's 500 plus 50. That's equal to 550. So what's the new price per share? Well, there are still 25 shares outstanding. The firm B shares simply disappear. So we have 550 divided by 25, or 22 per share. The gain is 2 per share. In case 2, we examine a stock acquisition. This is a little more complex. Remember, in the cash merger, firm B shareholders received cash and no longer participate in the firm. However, in a stock merger, B shareholders become shareholders in the new firm. Since no cash changes hands, the value of the merged firm is the sum of the two standalone values plus the incremental gain from the merger. That is VA plus VB plus delta V. And when you add that all together, it's equal to 700. So how many shares did A have to issue to buy B? Well, remember that shares of A are worth 20 each. And so to cover that 150, they have to issue 7.5 shares. I just took 150 and divided by 20 there. Now there are 25 plus 7.5, or 32.5 shares outstanding. So what's the new share price? Well, we said the value of the firm altogether is equal to 700. And we just divide that by 32.5 to arrive at $21.54 per share. So what's the cost of acquiring B? Well, those 7.5 shares at $21.54 apiece is $161.55. So what's the NPV? Well, it's 200, which was VB star, minus the cost to A to acquire B. That's 161.55. So the NPV is 38.45. So now we can check our work. We can take that NPV, divide it by the 25 original shares, and come up with $1.54. And the new share price is 20 plus 154, or 21.54. So that agrees with what we saw earlier. Now, why did I just divide by 25 original shares? Because we are concerned with the NPV to the original shareholders. They are the holders of those 25 original shares. So why is the cost higher for the stock versus the cash deal? Well, it's because A shareholders must share the gains with B shareholders. So there are some things to consider when choosing cash or stock. The first is sharing gains or losses. I don't like to share gains, but I love to share losses. If I think the merger is going to be a loss producer as a manager, what should I do? Why, offer stock, of course. And then there are taxes. cash usually results in taxes for the target shareholders, but stock does not. Finally, control. Cash doesn't affect control, but shares can. Why? When I issue new shares, it reduces the percentage of the firm owned by the original shareholders. It could cause one shareholder to go from being a 50% plus one shareholder to a minority shareholder, which could cause them to lose control of the firm. So which is more popular, stock or cash? Well, usually cash. Cash doesn't have a lot of the incentive problems that stocks do. For instance, if a manager offers you his stock for your firm, what does that mean he thinks about his stock? It's probably overvalued, or he wouldn't be offering it up. If it was undervalued, he'd be offering you cash. Managers of the target firm can actually take what are called defensive actions to help prevent being taken over. They've got many tools to do this, and we're getting ready to discuss them. But first of all, I want to ask, are these actions bad? And the answer is not if they end up getting a higher offer price for their shareholders. But if they prevent the sale of the firm at a higher price than the current share price, then they are bad. What about Yahoo? Jerry Yang kept Yahoo from being purchased by Microsoft. As a result, his shareholders missed out on a substantial premium. Some of the defensive actions that target managers can use are embedded in the corporate charter. What's a corporate charter? Well, it sets the rules for decision making in corporations. And you can amend your corporate charter to make takeovers more difficult. For instance, you could require a supermajority to approve mergers. Now, what's a supermajority? Well, that's that greater than or equal to 2/3 or greater than or equal to 3/4 that we discussed earlier in the lecture. And then there's also the concept of classified boards. This is where director elections are staggered. Imagine a board of 6 directors and they get re-elected every year. That means the entire board can get changed out at once. Now imagine that we only change out 1/3 of the directors every year, 2 this year, 2 the next, and 2 the year after that. That would take at least 2 years to get a majority of your people onto the board. That makes it harder to take over the corporation. Next, we'll talk about repurchase and standstill agreements. A standstill agreement is where the bidder agrees to limit its holdings in the target, and it usually marks the end of the takeover attempt. Now, would the bidder do this out of the pure kindness of their heart? Absolutely not. What incentivized them to do this? It's called a targeted repurchase. This is where the target firm buys its own stock back from a specific investor, in other words, the bidder, at a substantial premium. The bidder may have only paid $20, $25 a share, but the target will repurchase that at $40, $45, or $50 a share. And so this creates a great, huge return on investment for the bidder, and the bidder doesn't even have to take over the company. Now this sounds great from the bidder's perspective, but who gets hurt? Well, it turns out the target shareholders, it's their cash that's being used to purchase these shares back. And in the end, the target shareholders will not get the takeover premium. Remember, a targeted repurchase, the only person getting that kind of money is the bidder. The other target shareholders do not get that. And in fact, we have a name for this called green mail. You're basically paying the bidder to go away. It's not good for target shareholders. Now let's talk about poison pills and share rights plans. A poison pill is any financial device designed to make it impossible for a firm to be acquired without managerial consent, that is, the consent of target management, unless the acquirer is willing to commit financial suicide. How might this work? Well, you could take on, if you were the target, you could take on a lot of debt and pay out an enormous dividend to your existing shareholders.
And in this way, what you've done is made the company extraordinarily risky because it's financed primarily with debt. If something goes bad, can you pull that money back from the shareholders? No, there's no such thing as a negative dividend. And so basically, the company is left in a position of not being financially viable. Now, another firm could buy them, but they would be stuck with all this debt. Do you think target management really wants to make the firm unviable? No, but the point here is they'd be willing to do it to avoid being taken over. Then we have what are called share rights plans. This is where the company, the target firm, distributes rights to shareholders. By the way, a right is an option of a certain date, so the shareholders can't be new shareholders because that would include the bidder. So we say people that have held shares in the firm for the last year are able to buy stock, additional stock, at a steep discount in the event of a takeover attempt. Now, why would we do this? Because it dilutes the bidder's position. Think about this. If the bidder already has 5% of the firm, and by the way, they can have right up to 5% and not report their position to the SEC. But once they cross that 5% line, they have to report their position. And so as soon as they hit the 5% mark, that's when they have to make everyone aware of what they're trying to do. At that point, the company can activate the share rights plan, and the shareholders for the other 95% could get the option to buy an additional share of stock for each share they own at half price. And so now, instead of, let's say, having 100 shares outstanding, 5 of which are owned by the bidder, now we're going to have 195 outstanding, 5 of which are owned by the bidder. In other words, we nearly cut their proportional stake in the company in half through the share rights plan. It makes it much more difficult to take over the company. Now, what's the intention of these things? It's to force negotiation with target management, because all of these items can be rescinded by the target management and their board. The target management would tell you that they need these things in order to force a fair price out of the bidder. But there's also a bit of watching out for themselves, because sometimes out of these negotiations will come offers of payments to the managers themselves in the form of something called a golden parachute. Earlier we talked about going private transactions, and it turns out that this can also be used as a takeover defense. How? If the management is threatened by some sort of outside bidder, they can make their own offer to purchase the company, and in this way they can keep their jobs. So from a manager's perspective, this can be a takeover defense, but from the target shareholder's perspective, it is a takeover. Why would they not care? Because the target shareholders are going to receive a premium to tender their shares either way. Now we'll talk about divestitures and restructuring. What's a divestiture? That's when a firm sells assets, operations, divisions, and/or segments to a third party. Why would a divestiture happen? Well, usually after a merger, a firm will need to divest some assets, first of all, to avoid antitrust problems. For instance, when Exxon and Mobil merged, they had to sell some gas stations to third parties to avoid having a monopoly on gasoline in certain areas of the country. Secondly, to raise cash to pay for the deal. Keep in mind that a lot of these deals are funded with a huge amount of debt, and that debt is in the form of junk bonds. And those junk bonds will have a high yield to maturity, or a high coupon rate at least, and so you'll want to pay those off as quickly as you can. One way to pay those bonds off is to sell assets. And finally, after a merger, you'll end up with assets you don't want. For instance, after the merger of Halliburton and Dresser, there was a compressor firm that used to be part of Dresser called Waukesha. And Waukesha makes a fine compressor, but it's not a business that Halliburton had any interest in. And so they, through a divestiture, got rid of Waukesha in exchange for some cash. Now, divestitures can take different forms. You could have an equity carve-out, which is where the parent puts undesirable assets in a completely separate company, which is completely owned by the parent, and then sell a fraction in that separate company to the public via an IPO. Now, what does that do? That provides a publicly known value for the firm, at which point the parent firm could spin off the separate company following an equity carve-out. This is when they issue shares in that new firm to shareholders of the parent company on a pro rata basis. What does pro rata mean? It means if you own 10% in the parent company, you'll also wind up owning 10% in the new company. And then there's a potential for something called split up. This is typically done as a response to monopoly concern. This is where shareholders have their shares in the one big old firm exchanged for shares in the many new firms that are created through the split up, and once again that's on a pro rata basis. And really the only good example we have of this in modern times is the breakup of the Bell system back in the 1980s. At one time in this country, the Bell system, which is now AT&T, controlled pretty much all of the telephone conversation in the country. And finally, in the mid-1980s, it was decided that this constituted a monopoly that needed to be broken up. And so the Department of Justice went about splitting up the Bell system. And so you wound up with all the baby bells, like Bell South, Southwestern Bell, Mountain Bell, and all those. And if you had owned shares in the Bell system before the breakup, let's say you owned 10%, then you would own 10% in each one of the pieces that were split off of the company.